All right. Everybody should see that. Day trading strategies. This is really one of the first strategies or concepts that I first learned when I started trading. And actually, I started trading. I placed my first trades in 1997, so 24 years ago. Hard to believe. But really, actually, I think the first 4 years I was just throwing orders at the market during the tech bubble boom, and then just totally got wiped out because I didn't know what I was doing. So one, I'm very happy everybody's joining us for this. I know we've got traders of all different experience levels, but this was really one of the first ones after about 4 years learning lessons the hard way, or actually probably not learning them until it was just a really hard lesson pretty much over the course of a few weeks. Started looking at how do I do technical analysis, things like this. Very simple strategy. I'm pretty sure we can all count to three on here. If not, 1, 2, 3. So it's really about trendline divergence. So I'm going to cover the strategy basics. This whole presentation, this slide deck is 3 slides long. So we're going to spend a majority of the time in the platform. During this, I saw a couple of questions from people that missed part of the previous one. So I will be covering and reiterating some of the basics, and I'll be taking questions as we go along. So we're going to cover the basics of this strategy and then executing it at the Nadex platform. And I really think while this can be used for binary options, I think this is a great one for knockouts and what I think is arguably our best contract, call spreads. So with that, before we begin, trading involves risk. Hopefully you know this. If you put money in a market, the market can take it. With Nadex, you can lose all of the money that you put up for a trade. Unlike leverage markets where you can lose more than you put up on a trade, at Nadex you have defined risk, but it still involves risk. Rent money, grocery money, if your money is earmarked for something else, don't trade with it. It has to be risk capital. We have to take accountability for our decisions. We're going to be looking at what I call a lagging indicator, but we're also going to be looking at how we can implement it moving forward. This is in a demo account that I'm going to be doing this. I'm not going to be doing a ton of analysis when we're looking at the future trade, but I want to walk you through the basic concepts. So just because something looks great here or because I place a trade, if you've got a live account, don't just jump in and do that. It's just not a great idea because this is really to give you a concept and work through that. So my third and final slide, this is a strategy, not a guarantee. There's risk management. And also, while I'm going to be talking about a specific strategy, I really like to share some points about trading that I think are very important, and probably more important than any strategy. I remember when I really started doing this and thinking, gosh, if I just knew what timeframes the pros used, if I knew what indicators they used, I could be super successful at this. And what I learned, though, that any strategy, there are thousands of strategies out there. I've traded a lot of them. Almost any strategy can be successful if you have proper risk management. If you don't have proper risk management, no strategy in the world will be successful. And real quick story on strategies as a whole. So this goes back, wow, 2005, 2006, I want to say. There was a magazine called Currency Trader. I think it was Currency Trader. It was one of the trading magazines that they did this test. And what they did was they took 2 professional traders, a great deal of experience, very successful, and took 2 very inexperienced green traders. And they paired them up. So 1 pro with 1 novice, 1 pro with 1 novice, call them Team A, Team B. They gave them 30 days where they could trade the same market. So they had to trade Euro USD. Team A could only be long. They could only buy. Team B could only enter a position by selling or going short. So you'd think, right, one team is going to come out ahead, and they all traded by the same methodology, same strategy, same rules. What they found at the end of the 30 days, both of the professional traders made money. Both of the novices lost money. The reason for this was entirely risk management. So I really want to stress that aspect of it, because this is a strategy, but it is not good unless you can actually minimize your losses. You have to do the work. When I look at this strategy, I've been looking at it so long, I don't even draw lines anymore. It just pops right out. If this is your first time seeing it or even hearing about trendline divergence, it's going to take you a little bit of time. You're going to do a ton of analysis. The market is, and one of the things I love about it, trading is a never-ending process of learning. And when you think you actually know something about it, the market will slap you and prove you wrong. But what we want to do throughout all this is actually have something that we can replicate and do consistently. Another part of trading, and some great advice, is you don't need a super complex strategy. You don't need 40 million indicators. Often the simplest strategies that can be replicated day in, day out, and quantified are going to be the most successful. So I'm going to warn you up front, you have to do the work. I'm going to give you the basics of the model here today, but you won't see the markets the same way I do. You'll look at the exact same chart, the exact same indicators, but you'll see them in a slightly different way. So you'll have to understand for yourself, once you have the basic premise, how you work that into that trading module. So this is going to be basically a very simple strategy. We talked in the first session a lot about price action and just looking at price, but all we're going to be looking at is a divergence between price movement and what the perceived momentum of the market is. I like the RSI indicator, probably because it was the first one I used on this, but if you use the MACD, any real momentum indicator can be used. This can be standalone strategy, or it can be used as extra confirmation. So if you've already been trading for a while and you have a different strategy, you can perhaps add this as another tool or confirmation for a buy or sell type of signal. Like rock climbing, where you want 3 points of contact at all times, 3 points of confirmation are ideal for this strategy. We're going to cover this in the charts in great deal. Although very much, I don't know if anybody on the call has ever been skydiving, right? So we're going to count to 3 several times today, but sometimes, like skydiving, if you haven't been, the first couple times people go, they typically go tandem. And I still remember my first time, and so this is also a warning if you have plans to go skydiving. You'll get to the window or the door of the aircraft, and the person going tandem with you will say, okay, we're going to count to 3 and we're going to rock back and forth, and on 3 we're going to go. And invariably what happens is on 1 or 2 you're out of the plane. For this, 3 points of confirmation are ideal. We're going to look at some examples on where we could actually only have to count to 2. We're going to look at multi-time frame analysis. Again, we covered a bit in the first session. We'll talk more about that. This is absolutely a strategy where we're looking for tops where we'd want to sell and market bottoms where we'd want to buy. We'll cover the knockouts as well as the call spreads. For this strategy, I really actually prefer the call spreads. Again, more explanation when we get to the charts. If you look at patterns, I love this when we're looking at like double and triple tops or bottoms, ABCDs, Gartley's, butterflies. If you're not familiar with what those are, they're actually kind of in a family that was made pretty popular from Larry Pesavento, who I think I've read every single book he's ever put out, but very visual patterns. Not a lot of time to go into them on this particular one, but if you go to a search engine, you can find all the information you want. So that is the end of the actual presentation. Let's hop into the charts. And I know everybody's already had a lot. We've been on here quite a few hours. So again, one of the things I really love about this is just keeping it simple. So time frame analysis, and I'll try to hit all the key points. If you have questions, just type them into the box. I'll try to answer them as we go, and we'll talk about the contracts and how they're structured as we move through this as well. But basically what we're looking for. So on my chart, and I'm actually just going to pull up a tear-off chart here. Let that load up. Okay, so here's a tear-off chart. I want to give ourselves a little bit of extra space. So what I'm looking for, and if you see this, it looks like 3 points. Can everybody see that? I drew a trend line on there to make it a little bit more visible. Right? So we have a market that's trending up. Market that's been kind of moving up, moving up, moving up. Oftentimes these will be, and ideally these would be in a very nice symmetrical pattern, but not necessary all the time. Well, what's happening down here on momentum? This is the RSI indicator. And real quick, I'll show you how to apply that if you're new to the platform. Right here, click on indicators, go to RSI. As I mentioned earlier, you could use something like the momentum, you could use MACD. I prefer the RSI, and I just use the standard setting for this particular type of analysis. Right now, I'm looking at a daily chart. I find it very difficult to trade from a daily chart, particularly if I'm trading something like when I'm trading FX or futures. The reason being, these are really big moves. A chart is a chart is a chart. These are really big moves. What I'll typically do, and we'll filter through the time frames here, we look at a really broad spectrum of price movement first, try to identify key points of support or resistance, and then we'll filter down maybe to an hour chart and then maybe to a 5-minute chart. So in this case, this white trend line here, I just drew across the tops to illustrate that. If you notice what's happening on our momentum indicator, the momentum is dropping. When I see this first point, I always like to look for one over 70. So for example, it might be dropping, but this first point here, so we have this point, then it drops a little bit lower, and then it continues to drop. This is actually one of the rare cases where it's actually 4 points of confirmation. But right here on this third point would actually give us, and let me zoom in here a little bit, we'd be looking, and I'm going to cover the actual trading aspect of that. It sounds like my sound might be cutting in and out a little bit. Hopefully everybody can still hear me all right. We'd be looking for, right here on this third point, actually right in here, we'd be looking for a confirmation to sell. In this case, and we'll cover this as we place trades, the market did drop for a day. It actually dropped about 90 points. So it would have been a nice little trade on the sell. It ended up popping back up, and then we actually had another sell confirmation based on the fourth point lower. Can everybody see those? We had point 1, market continued up to this point 2, momentum had dropped down to just above the 70 level. We got our third one, so 1, 2, 3, that came up to another point. RSI had dropped again. It would have given us a nice sell, but if this was a shorter time frame chart, if it drops down, right, these patterns can fail. We want to make sure that we're locking in some profit. And we'll again cover this concept, because then it popped up again and we got a really great sell signal on the fourth point lower. So let's just see if we find another example here. Here's really a double bottom formation. I don't know if everybody can see that. Right there, where we basically had, can everybody see that white line? We kind of had basically 2 points here where the bottom, where the market was at the bottom. Not much of a signal though. And I want to show you these that don't work out as well, because it's key to understand when they're going to fail. But this is one of the reasons why I like the call spreads. Here, RSI was basically in a double bottom the same. If this one had been below the 30 level and then we saw it declining, what we're looking for is divergence. Here's another example. So let's take this one. See these peaks right here? What's happening to momentum? Let me just draw a line. We've got the market moving higher. Draw this so you can illustrate it. But momentum is shifting down. So the question is, why do I use the 70 and 30 points? It's my point of demarcation. Those are just the ones I use. Typically, RSI is used as an overbought, oversold. So the idea being, if it's over a 70, market's overbought, it might be time to sell. If it's below 30, it's maybe oversold and it's time to buy. I actually don't use it for that at all. What I actually do use it for, though, is to kind of quantify this whole strategy. So, for example, this point here was actually at a point of about 85. And then it dropped down to 70. And we can see as it comes down here, then it's like right about 70. So it just creates a visual. I'm actually going to cover the trading concepts in just a minute. What I want to do is just show show kind of the basic premise of this. So we're actually going to walk through a trading example. Also, what's very difficult, or what's easy in history and difficult to do in practice, is as this is happening live, because I can show you all sorts of pretty things that happened on charts. And what I'm really going to look for is one of these that failed, to give that example as well. But then we're going to go in and we're actually going to look, and again, in the demo account, so don't be placing trades, how this would actually shape up. if we were looking at placing a trade. So I'm just going to change my chart time frame here, and I'm going to go to the 1 hour and just show a few more examples. Let me zoom in here a little bit. This is a 1 hour chart, right? We've got price moving up. We've got momentum in a downtrend. Here's an opposite. We've got price moving down. Momentum, though, is starting to pick up. Momentum was below 30. It was down there about 25, or excuse me, 23 to about 25 to about 27. And we saw the trend line divergence. Here we see another one. This doesn't have 3 points. Sometimes I said, remember, we can go to. Here we see the market starting to flatten out. So if you use like candlestick patterns, different things, you can combine that with this analysis. Market drops. Momentum is dropping as we kind of hit that high. Let's see if we find, I could have swore I put on an example that failed. Oh, here's actually a good example of one that didn't work out so well. So we actually had these peaks going up, 1, 2, 3. Momentum was declining, and we actually got our sell signal, and so we could have been in this trade, right? So if we were in this trade, let's say we sold a call spread, we're in this trade, market moves down, we haven't collected any profit, and all of a sudden the market starts moving up. If it starts moving up, that's when we want to get out of our sell, because these can fail. So let's walk through a trade example. Is everybody kind of seeing this? I kind of take it for granted that it's just, hey, I'm looking for, if this is going up, if I'm making higher highs, is my RSI making lower highs, right? The tops are the highs. If I'm at the bottom, say for example in this, I'm making lower lows on price, but the lows of my RSI are actually going higher. Does that make sense? And that's really all we're looking for. Very simple. Markets making higher highs. The indicator, the highs are getting lower and lower when it reaches a peak. Yeah, what do I do with that info? That's a great question, because that's what we're going to do now, is actually get into that. So here's another one. So I just flipped to the 5 minute, and it just kind of popped out at me. This would actually be one that we could have gone on too. Typically, I like to wait for a third confirmation. I just have to understand. So if you see these 2 points, oops, do this. If you see these 2 points, right, we had a pretty big divergence. This was down about 11 and then came back up to about 23 where it bottomed out. Now, if I'm looking to buy or sell, I typically, when I'm trading in markets, I'm typically trading off a 5 or a 15-minute chart because I want to get granular when I'm looking to execute a trade. So this pops up. I want to wait 5 minutes, and we're going to walk through exactly why. I like to wait 5 minutes for a confirmation. I don't scalp necessarily with the strategy. Actually, I don't scalp in general. I know a lot of people love that. I wouldn't trade this with a 5-minute binary option. I'm actually looking at a trade that is probably that I'm looking at to go for maybe an hour or 2 hours. And maybe if I'm trading like a weekly call spread, I can let it go a week. So let's walk through actually executing a trade. I'm going to close out this chart here. And I'm just going to pop back in. Okay, we're going to actually go through and walk through a whole thing. So this is the daily chart. So to change the periodicity, daily, just going to pop this back to 5 minutes. And if I want to apply my RSI indicator, you can see in the upper left-hand corner, if you hover over it, it says indicators. Drop down. I'm just going to go down to the RSI. By the way, very helpful tool. And this is just kind of a tidbit, not about this strategy, but just in general. When you're looking at indicators, there are different types of indicators. There are momentum indicators, there are volatility indicators. If I'm using an RSI, first of all, I can put on there a question mark. Hopefully everybody can see that. Relative strength index, it tells me what it is, gives me a little bit of information. It's also a momentum indicator. So if I put an RSI on a chart, and this is going to be a basic example, if I click on a momentum indicator that is set basically to the exact same settings, it's not extra confirmation. Always understand the indicators you're using. In this case, we're going to focus on the RSI, but literally if they're set to the same settings, they'll be set to the same settings. They'll give you the same indication. Just a tidbit, because I have seen a lot of people put 4 or 5 different indicators on a chart, and all their trades are going against them, and they're like, why? I have all this confirmation. Well, it's basically because you asking me my opinion on the same thing 5 different times. I'm going to give you the same opinion every time. Same thing with indicators. So let's take a look at what we do with this information. So I'm just going to quickly flip through a chart here, and I'm going to see if we get anything that looks like it's tradable. So bear with me a second. There, and I'm going to do this pretty quickly. And you'll be able to do it very quickly as well. Here, so this is how they start popping out at you. Do you see this downslope? Bottom, bottom. But this actual, the RSI is going up. I'm going to pop back to one more pair here and see if we see anything in development. It's pretty slow time in the afternoon. As we talked about earlier, I actually like when we're for getting into trades and executing trades when we're actually in a bit busier time of the day. Because right now you start to see the markets go flat. So on these shorter time frames, we may not see anything really developing. There's a reason I make that point as well. If there's not an opportunity, you don't have to trade, right? You never have to trade. So one more here, and then I'm just going to place a trade. Euro USD weekly. We're going to go to the 1 hour chart. Yeah, actually, that's a great question, Leonard. I've used this in virtually every market. I've always been. I mean, I cut my, like as I mentioned, I cut my teeth in the stock market during the equity boom, and then got my teeth smashed in. But it was really when I hopped into futures, and then really started focusing on Forex around 2004, 2005, that I really like this. But yeah, I have used it. It's the same premise holds through really whatever market. Let's see. Wow, we got a lot of questions rolling in. So I'm going to cover them as we go through this. So we might have to you might have to follow along with me, and we'll have to do a little hypotheticals. Right now, we don't see anything really developing here, right? RSI is flat, but we're in kind of a later time of the day. That's why I went to a longer time chart. We saw 2 points drop. RSI also dropped. But let's say we were looking at this, and all of a sudden we see that this pattern's developed. We have a confirmation that we're hitting a bottom. So RSI has dropped. We've got another one. How do we execute that? And when I say flat markets, see if I find an example here. This has actually been kind of trending. I mean, you can see kind of like in here, this is a 1 hour chart. You see how that's just kind of sitting there, kind of stagnant. It's trending down a little bit. This would be more attuned to what I would consider a flat market. Lately, they haven't stayed flat for very long. There's a lot of stuff going on in the markets, but typically when you see a little bit tighter channel, that's what I mean by a flatter market. So right, and the question is, wouldn't I sell? Actually, right now, if this was my actual trading account, I wouldn't do anything because I don't have a confirmation. So we're going to have to use a couple of hypotheticals here in that, because of the time of day we're at. We might see something tomorrow morning, and we could walk through. So for example, up here where we saw this, right? Market's moving higher, RSI is dropping. But because I also want to cover the basics of the contract. So what I'm doing right now is I'm going to go, we've got knockouts, call spreads. Is everybody clear on the difference between a knockout and a call spread? Because they're structured virtually identical. Right? A knockout is just what the name implies. If it hits either the upper or lower boundary, the contract gets knocked out. If you've traded using what are called OCO orders, one cancels the other. A knockout is effectively that. It's just where the OCO is preset. Call spreads. The reason I really like the call spreads, and I'm kind of biased because I actually designed them years ago. I can't really take credit for that, though. It's basically taking a very simple options concept, and all we did was package it as a single unit, make it a little bit easier to buy or sell. With a call spread, and even with a knockout, what I'm typically looking to do is buy closer to a floor and sell closer to a ceiling, so I have more potential upside than I do risk. Now, I know I can tell by the questions, we've got a lot of people who've traded on here before. Has anybody gotten into a trade ever? The market just looks like it's setting up perfectly. They get into a trade, and let's say they place a buy order. This has happened to me a million times. All of a sudden, the market swings down, hits my stop, and then rockets off in the direction of what would have been my thing. And I'm just sitting there scratching my head. It's like the market had eyes. And all of a sudden, though, I'm out of the trade. Yeah, I know a lot of people that pretty much if you've traded more than half an hour, this has probably happened to you. But you have to use stops, right, in most markets. And like I was a trading coach in the FX space, and I love the FX market. And I think there's a lot of complementary things that you can do with these, particularly with call spreads. And if you're trading, like FX, like at our sister company IG, where you can actually do some very complementary trades. But yeah, it just feels like the worst thing. I mean, it's almost like oh man, the market's just going against me. It's not. It happens. But the beauty, and what I think is the beauty of a call spread, and we're going to walk through this. So I'm just going to say I'm going to look here, and let's say my indication was to buy. So if I was looking at this, if I met the RSI, and let's say we're getting our third point, I like to see a small shift, something to indicate that it's bottomed out or it's topped out. That might be a candlestick pattern. So at the close of like here, we can kind of see some uncertainty in the market, some type of confirmation. But so we can get to the contract while we still have plenty of time here. If I'm looking to buy, the market right now is at 119, basically 05. So I'm in the Euro USD. So very easily, and you can see them on the chart as well. I'm going to bring that up. But 119.05 is where the market is. And I'm going to walk through both a buy and sell example here. So right now, I've got a floor on this contract. Right now, the market's at 119.06. My floor, though, is all the way up at 119.49. So let me pop on that here. Okay, yeah, I just had to scroll up. So in order for me to make any money on this trade, the market at least has to cover this plus my buy. So let's find one a little bit closer. These are the weeklies buy, so they're big. So they're big ranges. We've only got 27 minutes left in the daily binaries. But when you look at the daily versus the weekly and the intraday, so they'll have smaller ranges across the time frames. So weeklies, obviously, to encapsulate what you would expect of an average weekly market move, we'd look at that. So we're at 119.06. So right here, and we don't have much time left, I can actually still buy this contract right here, but I've got a lot of ground to make up. I might hold off on this one a little bit. Again, we're late in the day. Typically earlier in the day is going to be a better time to look at these. But let's walk through a trading example. And I'm just going to pick a center of the range here where we have almost equal max loss to max reward. The thing I love about these, and I'm going to draw a few lines to illustrate. Let's say, okay, use your imagination with me. I'm going to put this line down here. So 118.49. Everybody see that white line? If I buy this contract right now, I'm going to pay a bit of premium. So even though the market's at 119.06, if this was my floor, I might pay 119.15 or 119.20. The reason I'm willing to pay or give a little premium to the market is if this happens. If I am trading, and this is what we were just talking about, right? I buy, and all of a sudden the market does this, right? It goes below the floor. And by a lot of responses, we've all seen this happen. And then the market does this, right? Previously, we'd have been stopped out, right? The market comes down, hits our stop, and then rockets off. With a call spread, I am still in this trade. Basically, what I've done is bought a bit of time to be right. And that's what the whole premise is here. So I pay a bit of time premium. If you're familiar with options, it's a very familiar concept. The more volatile the markets are, the more premium you may have to pay. So let's walk through a trade example. Does that make sense to everybody? Even though there's floors and ceilings, the floor and ceiling mitigates our risk. So if we're buying, our maximum loss is wherever we buy to the floor. If it hits the floor or goes past and stays down there until expiration, well, we've lost that, but that was it. But if it shoots down below the floor, we're still in the trade. If it comes up, we can still be profitable. Does that make sense to everybody, that you don't get stopped out? You're in this trade until the expiration of time or until you choose to close it out. Perfect. And that's one of the things. If I look at like my trading history, by the way, I hope everybody keeps a trading log. I actually like to do mine visually and then print them out. Often we're looking for patterns in the market, but by doing that, and when we can actually look at all of our trades and reflect on them, we can learn a lot more, and it helps us identify patterns in ourselves, which are far more important than any patterns that the market can ever produce. So let's actually walk through, because we're getting a lot of like trading concept type questions. And so I'm going to try to answer. I'm just looking through them quickly because I think I can cover quite a few of them. So we're going to walk through this. I'm going to place 10 contracts because I'm going to show a couple of concepts. I'm going to click buy. Right now, we are in the center of the range. So not ideal. I actually, if I'm mitigating my risk, would want to buy near a floor, right? I pay a little bit of premium, but I get a whole lot of protection. If I'm selling, I typically want to look close to a ceiling. Again, ideal time for this particular strategy in my mind is during the overlap of the Europe and the US session, or whenever there's overlap. If you're in the time zone of overnight, where you're looking at the close of the Asian session and the open of the Europe, all good times. Unfortunately, 1:30 on a Tuesday afternoon is not the greatest time to actually find trades. But let's just place this order. So I've bought this contract, and we're going to do some hypotheticals here. So I've got a couple of things. I'm just going to fill this in. Say this is my floor. I don't have to take the full loss. So I'd love to be able to sit here all day and watch watch the market and see how these develop. But in the time we have, we're going to run some hypotheticals. So I just bought this. We're going to say the market does this, starts moving against us. While we have that protection of the floor, if we want to close this position out, we don't have to take the max loss. It's there as protection, but if I want to close this out, I'm simply going to click on my open position window. Did you see how that, I'm going to do it again as well. It opens up on the opposite side. So if I bought my contract and I click on my open position, it's going to open up a sell ticket or ticket to sell in the same size as my position. So if I want to exit this trade, I could simply click place order. I'm going to get rid of this line. Yeah, you know what? I'm going to leave that on there. In our hypotheticals, market started to bottom out. We stayed in our position. Now it's up here. We're going to have a ceiling, And let's just say hypothetically, our ceiling is up here. That's our maximum potential profit, right? So it's basically a range. We don't have to wait for the ceiling to be hit. As a matter of fact, one of the key things about this whole strategy, when we're looking at that trend line divergence and we get our 3 points lined up, sometimes 2, sometimes 4, right? We make our decision to buy or sell. This is where, as I mentioned earlier, trading multiple contracts can be very beneficial, because oftentimes a trade can work in your favor for a while and then all of a sudden reverse, and it's not. And if I only have one contract on, right, I have to decide where to close it out. So let's say this was my initial profit target, and I'm going to put another vertical line, or excuse me, horizontal line on here. This is my initial profit target, and I'm just going to make this one green. So that green line was my initial profit target. If I've only got one contract on, that's where I have to close it out. And we'll walk through limit orders in a minute. That's where I have to close it out, and then I'm out of the trade. Another thing I think we've all seen is we close out of a trade, and all of a sudden the market keeps going like this, and we're like, wow, we missed most of that. So if we have 2 contracts on, we can close 2 contracts. So let's say we got into this trade right here at this current price. We bought at 119.06. I'm going to click on my open position. And what I want to do now is set a limit order. So I put on 10 contracts. What I might like to do, and this is, I'm going to set a limit order for 4 contracts. We bought at 119.06. I think it might hit the middle of this range here. So my target is 119.20. I'm simply going to take 4 contracts and say 119, I'm just going to say 119.25 is my target. And click place order. What I have now is a working order for 4 contracts. So if the market from here moves down, comes back up, it's going to close off 4 contracts. So if the market continues like this, I'm still making profit. However, if the market then decides, well, I'm going to give you a little bit, and it comes back down and it drops like this, something has shifted. Maybe I get a signal to either reverse or just close out the position. I can close out the remainder of my position here, and I've still made money, right? Because I took profit. If it continues like this, right, maybe I have a secondary profit target. So I'm going to move this green line up here. Maybe this was my secondary profit target. I'm going to take another 4 contracts off. And so I'll set this one at whatever that is, 119.65. Right? I place that order. So now as the market moves up here, I've taken off another 4, and now I can actually get some value. If it continues all the way up to the ceiling, I've made maximum profit. And yes, I'm going to walk through how to close out these trades. So real quick, I've got my position on. I just want to close it out. I just want to get out of my trade right now. So I'm going to click on this. It's going to open. So right down here on the position window, I'm going to walk through it very slow. Positions window. This is my open position. Right now I've got a loss of $40. I click right on there, right on the contract name. This order ticket is opened in the opposite side of the market. So if I bought, it will open up a sell ticket. It will also open up in the total size of the number of contracts I have. So my position size is 10. This opened up as 10. If I just want to get out, I might change that to a market order and click place order. And then I'm out of my position. Now what I want to do though is I want to make sure, because I have these working orders out there, these are very easy. Again, if I see orders, click on this, I just simply click delete order. From the orders tab, click on this, click delete order. Does that make sense how to delete orders? Cool. Let's walk through another scenario and just implementing a strategy on this. I'm going to just switch to a market, kind of do it blind, but walk through the whole process walk through the whole process again. So, you know what, I'm going to choose a weekly contract here because we're coming up to the end of the day. I'm just going to look at this. Oh, I didn't mean to place that order there. Let's close out our RSI. Okay, so right now we have a 1 hour chart. This is a weekly contract. The market is at 124.41. So for my first step, I'm going to bring up my RSI. So actually what we have here, we're looking at this. This is one that actually might be forming right now. Now, granted, we're in a little bit slower of the time, but you see how the market's been actually dropping. This one, but RSI is going from here to here to here. Does everybody see that? This is one that's developing. We're actually now just below. We're like really like right at the bottom. So this is just below. Right now, what I would do is I'd flip to my 5-minute chart because I want to get a bit more granular. Is everybody following along so far? Right, we've been dropping. RSI has been going higher, right? And right in here, actually at this point, we would have had a buy signal. So let's say we did buy here. If we dropped and then the market came down, well, if we didn't take profit, we'd still be in a trade. Now we'd probably be looking at a loss. If I see this developing on a 1 hour chart, I'm going to go to my 5-minute. I'm going to see if I get kind of any indication here. And what we're seeing is actually we already have 1, 2, 3. So right in here was our buy signal. Does everybody get that? On the 5-minute. So on this one, we're a little bit late. I'll walk through that as well. All right. So right now the market's at 124.43. 124.44. So right now, I'm actually going to go into this one. Okay, so right here's my, choose the wide one there. So, all right, so let's just walk through. I want to buy this contract, and we're going to take a look at scaling. So, a lot of questions rolling in. Okay, I'm going to just set my contract size here. I'm not advising you to trade in 10 contracts. Always follow your risk management. This is for example only. I'm going to place this order. I've got just about a 1 3/4 or 1.5 to 1 risk reward ratio on this. So I placed my order, right? I see it in my open positions window. So what I want to do next, I want to set up some take profit targets. And we're running short on time here. So I'm just going to say, look, you know what? We had some support here, which also became previous resistance. I could use fib levels if you use that. I'm going to set, and I'm just going to draw a line here. I'm going to set a take profit order, say 124.52. So if I want to set a take profit order from my open positions window, I click here. Automatically opens up an order ticket in the opposite direction. I don't want to close out my whole position though. So what I'm going to do is I'm going to change this, and I'm just going to say, you know what? I'm going to close off half a position. I'm going to clean it so it's 5. I want to make sure that my order is limit good till canceled. And what did we say that level was? We'll say 124.55. Close enough. 55. So now if price moves up, hits that green line, I've closed out 5 contracts. From there, I can just manage my position. If it continues to move in my favor, and this is a weekly contract, so it expires in 3 days. If it continues to move up, I can continue. Maybe I take a couple more contracts up. If it drops back down, maybe I just close out the whole position. So if I click out, and I'm going to do a sell example real quick, and then I'm going to have to wrap it up. I think I've answered most of the questions. If not, I'll have to follow up. So I'm just going to close out this position. So again, click on the open position window. It's going to open it for the full amount of 10 contracts. In this case, I could just use a market order. Always want to make sure we go in, close out our orders. If we have any orders that aren't attached to positions that we don't know are there, click delete order. And so now I'm flat. I have no open positions, and I've canceled all of my working orders. So I'm going to scroll through the questions here real quick, but actually this is one on a longer time frame that could still be developing. What I would love to see in this particular case is if the market dropped a little bit farther down again, and then I got an indication, but the RSI stayed up here, this could be another indication that we have, a decent buying opportunity. Now, all of a sudden, the market could drop like substantially. That's why we want to manage our risk, because it can fail just as rapidly as it works. I know I threw a lot at you with this one, and you've had a lot of information thrown at you through the day. What I want to give you is a basic premise on how you can utilize these contracts, but really the biggest part, right? You're looking for divergence. This market here is dropping and maybe it continues to drop. If all of a sudden the RSI stalls out right about here, if the market drops a little bit more on the 1 hour, go to the more granular 5 minute, see if you get an indication, a similar indication on the third point, let it soak for about 5 minutes, get a confirmation, and then it's time to execute your trade. So with that, I know I want to be mindful of everybody's need to take a break. It's been a long day already. Really appreciate the questions. I know that I've missed several of them. So I'm going to go back through following this and I'll try to answer those that haven't been answered. As well as if I miss one or one requires further explanation, I'll shoot you an email to let you know. So hopefully this wasn't overly confusing. The main thing is risk management. I love to scale out of trades where you collect profit quickly, but if it goes against you, don't be afraid to just exit the trade. Don't think you have to sit there for full loss.